Hey everyone, welcome back. Today, we're going to be doing a deep dive into the world of stockbroking companies.
Oh, interesting.
Yeah, and we're going to be looking at some of the insights from financial expert Dr. Vijay Malik. So, you might be thinking stockbrokers, that's just for Wall Street. But trust me, this deep dive is really relevant to all of us.
Absolutely. I think whether you actively trade stocks or not, the health of these companies, impacts the entire financial system. And that ultimately affects, everyone's investments and the economy as a whole.
Right, yeah. Like we're all kind of tied into that system, whether we realize it or not. So Dr. Malik kicks things off by comparing um, the stockbroking business to a roller coaster ride.
Okay.
And I got to say, the analogy is pretty spot on.
Yeah, I can see that.
Yeah, because their fortunes are directly tied to the ups and downs of the stock market, right?
Exactly. Yeah. You think about it, when the market's booming, there are tons of IPOs. Companies are merging, everyone's making money. Brokers are, riding high, raking in those trading fees. But then, like, bam, a bear market hits and suddenly everything comes to a screeching halt.
Yeah, it's like hitting that sudden drop on a roller coaster.
Yeah.
Like you know it's coming, but it still takes your breath away.
Oh, for sure.
And Dr. Malik actually uses the 2008-09 global financial crisis as a prime example.
Yeah.
It was just brutal for brokers. A lot of them went belly up. But then just a few years later, the post-COVID recovery in 2021-22, brought a whole new wave of investors, a lot of them, like trading from their living rooms.
Yeah, that's right. I think the work from home trend, coupled with just like the surge in retail investors, it injected this new life into the stockbroking business. I think it's a testament to like the industry's ability to adapt and evolve, even when faced with major disruptions.
Right, yeah. And I think it speaks to how accessible trading has become for the average person, right?
Oh, definitely.
Like you don't need to be like a high-powered, finance person, but it's not just market volatility they have to deal with, right? These companies are locked in like this fierce competition, especially with the rise of all these like online discount brokers, like Zerodha and Upstocks. I mean, remember when we used to pay like hefty brokerage fees,
Oh, yeah.
like 0.75% of our trade value?
Uh-huh.
And now some platforms are practically giving trades away for free.
Yeah, it's crazy. So this intense price war has made, survival incredibly difficult, especially for smaller players. It's this race to the bottom on pricing, which puts immense pressure on profit margins, particularly during, market downturns when trading volume dries up.
Yeah, so it's like, how do these companies stay afloat amidst all this chaos?
Right.
Like, what are they doing? And Dr. Malik highlights two kind of key strategies. He talks about economies of scale and then like asset-light operations. So it's all about like efficiency and flexibility, I guess.
Yeah, for sure. So larger brokers, they benefit from economies of scale. They can spread their fixed costs, things like, technology infrastructure, regulatory compliance over a much larger customer base. So this means that their cost per transaction is lower, giving them an edge, especially when revenues are tight.
So it's like the wholesale discount of the trading world. But what about those asset-light operations?
Yeah.
Is that just like a fancy way of saying cutting costs?
Well, it's more nuanced than that. Asset-light brokers, they prioritize minimizing fixed costs. So that could be by relying on technology, outsourcing certain functions, and sometimes even operating through, franchise models. This allows them to be more, agile and responsive to market changes. So think fewer fancy offices and more streamlined operations.
Okay. Sounds pretty smart, right?
Mm.
But Dr. Malik warns against taking cost cutting too far, especially when it comes to like critical areas like technology and risk management. Remember that fat finger trade error by MK Global?
Oh, yeah. That's a perfect example of why cutting corners in risk management can backfire, and spectacularly.
Yeah, right.
MK Global lost, a significant amount of money due to a simple typographical error in their trading system. So it highlights the crucial need for robust systems, even when trying to be, cost efficient.
Yeah, so it's like you're walking this tightrope.
Yeah.
Like you're trying to stay lean, but then you also need to invest in the things that are going to protect you when the market kind of like throws a curveball.
Absolutely.
But it's not just about trading anymore, is it?
No, not at all.
Like these brokers are getting creative with how they make money, right?
Yeah.
They're venturing beyond those like traditional brokerage fees.
Absolutely. So they're diversifying their revenue streams. So expanding into areas like investment banking, wealth management, and even, distributing financial products like mutual funds and insurance. So think of it as creating multiple lines of defense against the cyclical nature of the stock market.
Okay, yeah. So instead of putting all their eggs in the trading basket,
Right.
they're building like a more diverse portfolio of services.
Yeah.
That's a smart move in such a volatile industry. They're also casting a wider net when it comes to their clientele, right?
Yeah.
Not just targeting like those seasoned investors anymore.
Exactly. So brokers are now serving a much broader spectrum of clients from, first-time retail investors dipping their toes in the market all the way to, high net worth individuals and large institutional players. It's all about, reaching new markets and expanding their customer base.
Right. So it's like, everybody's welcome, essentially.
Pretty much.
Come on in. But even with all this diversification, I imagine when a major crisis hits,
Mm.
like the one in 2008, everyone feels the pain, right?
Yeah, unfortunately, that's true. During those, systemic shocks, even the most diversified firms can experience a downturn in earnings. However,
No.
diversification does help to, mitigate the impact,
Okay.
allows them to bounce back faster.
So it's like it lessens the blow a little bit.
That's exactly.
So we've established that this business is incredibly volatile, fiercely competitive, and it demands constant adaptation.
Yeah.
But we haven't even touched upon the elephant in the room. Risk.
Yes, risk. Risk is the ever-present companion in the world of stockbroking. There are multiple types that they need to manage carefully,
Uh-huh.
each with its unique challenges and implications.
So let's start with like credit risk.
Okay.
To me, that sounds like the financial equivalent of a trust fall.
Yeah.
Like these brokers are often financing their clients' trades, but what happens if those clients like can't pay up?
Ouch.
Yeah, right.
Yeah, that's exactly right. If a client, defaults on their obligations, the broker is left holding the bag, potentially facing significant losses. This is why robust client assessment and risk management protocols are paramount.
Yeah, and then there's market risk,
Hmm.
which seems particularly relevant for brokers who are engaging in proprietary trading, right?
Yes,
Where they're using their own capital to make like market bets.
exactly. While it can be, highly profitable when those bets pay off, it also exposes them to, potentially substantial losses if the market takes an unexpected turn. Fluctuations in, interest rates, currency exchange rates, or even, just plain old investor sentiment can all impact their portfolio and their bottom line.
Yeah, it sounds like a high stakes game where you need like a deep understanding of market dynamics and like a strong risk appetite.
Absolutely.
But even the most experienced traders can get caught off guard by like these unexpected market events, right?
Oh, for sure. The
Yeah.
market is incredibly complex, influenced by countless factors, from global economic trends to geopolitical events. It's a constantly evolving beast, and predicting its movements with absolute certainty is impossible.
Yeah, it's like trying to predict the weather,
Yes,
but with even more variables in play.
exactly.
Okay, speaking of things that can be unpredictable,
Hmm.
let's talk about operations risk. In today's like tech-driven world, it seems like this would be a major concern for brokers. After all, like, technology is the backbone of modern trading.
You're absolutely right. Brokers, rely heavily on sophisticated technology systems for executing trades, managing risk, and ensuring, everything runs smoothly. However, even the most advanced systems can fail, leaving them vulnerable to disruptions and potential losses.
Yeah, I'm thinking about like that time a squirrel chewed through a power cable
Oh, yeah.
and caused a major outage at NASDAQ. It sounds almost comical,
Right.
but the consequences were very real.
Yeah, that's a great example of how seemingly minor events can have a significant impact. And let's not forget the recent case of, Zeroda's app crashing, leaving thousands of users unable to trade. These incidents are stark reminders that no technology is foolproof. And brokers need to have, robust backup systems and disaster recovery plans in place.
Right, yeah, because the fallout from like an operational failure can be like really severe.
Oh.
Like it's impacting not just their finances, but also their reputation, right?
Yeah, yeah.
In today's like digital age, news of like a system outage or a security breach,
Hmm.
it can spread like wildfire, right?
Oh, for sure.
And it can erode like customer trust
Uh-huh.
and potentially lead to a loss of business.
And that brings us to another crucial aspect of operations risk: human error.
Oh, yeah.
Even in the most automated trading environments, human oversight is critical.
You mean like the classic fat finger trade?
Exactly.
Where like a simple typo can lead to millions in losses.
You got it. Remember the case of MK Global, where a trader accidentally entered an order for like billions of rupees instead of millions. That single mistake cost them, dearly and highlighted the importance of checks and balances to prevent such errors.
Hmm.
It's not just about having, sophisticated technology. It's also about training staff, implementing clear procedures, and fostering like a culture of accountability.
Right. Yeah, because, people are going to make mistakes. But you want to have systems in place to catch those mistakes, ideally before they cause major problems.
For sure.
Okay, so it seems like there are risks lurking around every corner in this industry, right?
Yeah.
And then there's the one that's kind of unique to finance, right?
Yeah.
Regulatory risk.
Regulatory risk. The world of finance is heavily regulated and for good reason.
Uh-huh.
Regulators play a crucial role in ensuring, market stability, protecting investors, and preventing, fraud and abuse. But those regulations can also be a double-edged sword for brokers.
Right. So on the one hand, regulations create like a level playing field, right?
Mm-hmm.
They ensure fair competition and they kind of enhance like investor confidence.
Mm-hmm.
But on the other hand, they can be like really burdensome,
Yeah.
costly to comply with, and sometimes they can even stifle innovation.
It's a constant balancing act.
Yeah, for sure. And the regulatory landscape, like it's constantly evolving with new rules and regulations being introduced all the time.
Okay.
So these brokers need to be like adaptable,
Mm-hmm.
staying abreast of the latest changes and kind of adjusting their business practices accordingly.
Absolutely.
Dr. Malik even gives the example of SEBI's 2015 decision to increase the minimum contract size for derivatives trades. And this seemingly minor change had like a significant impact on brokers' revenues.
Yeah.
Like it just highlights the need for them to be proactive and to engage with regulators, to like really understand the potential consequences of new rules.
That's an excellent point. Brokers can't afford to be, passive bystanders in the regulatory process. They need to understand the rationale behind new rules and regulations and proactively adapt their business models to ensure compliance while, minimizing any negative impact on their operations.
Yeah, it's not just about like following the rules blindly.
Right.
It's about understanding why those rules are in place.
Absolutely.
Okay. So we've covered a lot of ground here.
Yes, we have.
From like the volatile nature of the business to the cutthroat competition, the diverse strategies for survival, and the ever-present risks.
Mm-hmm.
But before we wrap up this part of our deep dive, there's one final point Dr. Malik makes that I think is especially important for our listeners.
Okay.
He cautions us that a broker's annual report doesn't always tell the whole story about their risk profile.
Ooh, that's a crucial point. I think, investors often rely on those annual reports to assess a company's financial health, but these reports can be complex and sometimes, they obfuscate the true picture.
Right. It's like judging a book by its cover.
Yes.
You might be missing some critical details. And to make things even more complicated, Dr. Malik points out that there's this like lack of standardized credit provisioning and market risk models across the industry. It's like trying to compare recipes when everyone's using like different units of measurement.
Absolutely. This lack of standardization makes it incredibly difficult to compare, brokers apples to apples and understand their true risk exposure. It really underscores the need for investors to look beyond the surface and dig deeper into the details.
And to make things even trickier, Dr. Malik highlights how brokers often rely on their own like in-house pricing models for assets like private equity and venture capital.
Yeah, those in-house models can be, opaque and difficult for outsiders to verify independently. It's another layer of complexity that investors need to be aware of.
Right. So while those annual reports provide like a starting point, they shouldn't be taken at face value.
Definitely not.
Like critical thinking and careful analysis are essential for any informed like investment decision.
Absolutely. When it comes to finance, there's often, more than meets the eye.
Yeah, for sure. We've covered a lot of ground in this first part of our deep dive, but there's still much more to explore.
Oh, yeah.
So in the next part, we'll continue our journey into the world of stockbroking companies. We'll delve even deeper into like the intricacies of their operations and the factors that drive their success.
It's going to be great. Stay tuned, folks, because we're about to get into like the nitty-gritty of what makes these companies tick.
I love it.
Yeah. Welcome back to our deep dive into the world of stockbroking companies.
Yeah, we're picking up right where we left off, kind of peeling back the layers of this complex and fascinating industry.
And today we're going to focus on something that's absolutely crucial for understanding how these companies operate.
Okay.
Risk management.
Risk management, because as we've already established, risk is kind of inherent in everything these firms do. It's like a constant undercurrent shaping their decisions and strategies.
Exactly.
We've already touched on credit risk,
Right.
which arises, when clients can't meet their financial obligations.
Yeah.
Think of it as like the potential for a domino effect.
Yep.
If one client defaults, it can trigger this chain reaction that impacts the broker's entire portfolio.
Absolutely.
Definitely that situation any broker wants to find themselves in.
No.
But I'm curious, is there a way to quantify that risk?
Yeah.
Like, how do brokers even begin to assess the likelihood of a client defaulting?
Well, that's where, sophisticated risk management systems come into play. Brokers use a variety of tools and techniques to assess, client creditworthiness, including analyzing, their financial history, credit scores, and trading patterns.
Okay, so it's not just about, like, blindly trusting clients. There's a whole, like, science behind evaluating their risk profile.
Absolutely. And it's an ongoing process.
Okay.
Brokers constantly monitor their clients' activities and adjust their risk exposure accordingly.
Gotcha. So credit risk is just, like, one piece of the puzzle, right?
Yeah.
Another critical aspect is market risk, the potential for losses due to, like, overall market fluctuations. And this one seems particularly relevant for brokers who are engaging in proprietary trading, right?
Yeah.
Where they're, like, putting their own capital on the line.
Exactly. It's
Yeah.
like they're playing both sides of the game,
Right.
facilitating trades for clients while also, making their own bets on market movements.
Yeah, and while that can be, like, highly profitable when those bets pay off,
Yeah.
it also exposes them to substantial losses if the market takes an unexpected turn.
For sure.
Right. And remember, the market is, like, influenced by a myriad of factors, right?
Oh, yeah.
From global economic trends to geopolitical events, things that are often impossible to predict with certainty.
Exactly.
So it seems like navigating market risk requires this delicate balance between, like, calculated risk-taking and a healthy dose of caution.
Yeah.
You need to be, like, confident in your analysis, but also acknowledging that the market can always surprise you.
Yeah. That's a great way to put it. Successful brokers understand that market risk is an inherent part of the game, and they develop, strategies to mitigate it,
Okay.
such as, diversifying their portfolio, setting stop-loss orders, and hedging their bets.
Okay, so it's about having a plan, like, for every scenario,
Mm-hmm.
understanding that you can't, like, control the market,
Right.
but you can control how you react to its movements.
Oh, exactly.
Okay. Speaking of things that can be unpredictable, let's
Yeah.
talk about operations risk.
Okay.
In today's, like, tech-driven world, it seems like this would be a major concern for brokers, given their, like, heavy reliance on technology for practically everything.
You're absolutely right. Technology is both a blessing and a curse for brokers.
Okay.
On the one hand, it allows them to, execute trades at lightning speed, process vast amounts of data, and connect with clients around the globe. But on the other hand, it introduces, new vulnerabilities and potential points of failure.
We've already talked about, the infamous squirrel incident at NASDAQ and the Zerota app crash.
Yeah.
These real-world examples highlight just how disruptive a technology failure can be.
Absolutely.
It's not just about, financial losses.
Right.
It's also about, reputational damage and a loss of customer trust.
Exactly. In today's digital age, news of a system outage or a security breach can spread like wildfire,
Right.
eroding customer confidence and potentially leading to a loss of business.
So this is why brokers need to invest heavily in robust technology infrastructure, backup systems, disaster recovery plans, and cybersecurity protocols.
Absolutely.
It sounds like they need to be prepared for, like, every possible scenario, from, natural disasters to cyber attacks to simple human error.
Absolutely. And that brings us to a crucial aspect of operations risk that's often overlooked.
Okay.
Human error.
Human error, yeah.
Even in the most automated trading environments, human oversight is critical. Remember the MKI Global fat finger trade error we discussed earlier.
Yeah.
That's a prime example of how a simple mistake can have, catastrophic consequences.
Right. It's a stark reminder that no matter how sophisticated our technology becomes,
Yeah,
the human element will always be a factor in any system.
absolutely.
So brokers need to invest in training, implement like clear procedures,
Hmm.
and foster a culture of accountability to minimize the risk of human error.
Couldn't agree more. And on that note, let's shift gears and talk about another type of risk that's unique to the financial industry, regulatory risk.
Regulatory risk.
It's a world of constantly evolving rules and regulations, and brokers need to be, nimble to keep up.
It's like playing a game where the rules can change at any moment without warning.
Yeah, pretty much.
Yeah, I imagine this could be like incredibly challenging for brokers, especially given the global nature of financial markets. Each country has its own set of regulations.
Yeah.
And then there are international bodies like, the Financial Stability Board that introduce their own rules.
Exactly.
So you're painting a very accurate picture.
Yeah.
Like these brokers need to have a deep understanding of the regulatory landscape
Yeah.
in every jurisdiction where they operate.
Mm-hmm.
And they need to be able to adapt quickly to any changes.
Absolutely.
It's a complex and demanding task,
It is.
requiring like a dedicated team of compliance experts
Mm-hmm.
and a proactive approach to staying informed.
For sure.
Dr. Melick even gives the example of SEBI's 2015 decision to increase the minimum contract size for derivatives trades.
Yeah.
It seemed like a relatively minor change,
Right.
but it had a significant impact on brokers' revenues.
Yeah, for sure.
So it demonstrates just how impactful regulatory decisions can be,
Mm-hmm.
even when they seem like small.
That's a great illustration of how regulatory risk can, manifest. Sometimes even, seemingly minor rule changes can have this ripple effect throughout the industry,
Right.
impacting everything from, trading volumes to profit margins. Brokers need to be constantly on their toes, anticipating, potential regulatory shifts,
Right.
and developing strategies to adapt.
Okay, so we've covered, credit risk, market risk, operations risk,
Mm-hmm.
and regulatory risk. Like, it's a lot to take in.
It is.
But I'm starting to understand just how complex
Yeah.
and challenging this business really is.
It is.
There's so many like moving parts and so much potential for things to go wrong.
Yeah.
It makes me wonder, like, how do brokers even make money amidst all
Yeah.
this uncertainty?
That's a great question, and it leads us perfectly into, the next part of our deep dive, where we'll delve into the financial statements of stockbroking companies. We'll explore, the key metrics to look for, the red flags to watch out for, and how to assess the overall, financial health and stability of these companies.
Sounds fascinating. I'm ready to put on my financial analyst hat and dive into the numbers.
I love it.
Yeah.
Let's do it.
Stay tuned, folks, because we're about to get into the nitty-gritty of what makes these companies tick. Welcome back, Deep Divers. We're in the final stretch of our exploration into the world of stockbroking companies.
And as promised, we're gonna, roll up our sleeves and get into the numbers.
Okay, so we're diving into those financial statements,
Yeah.
but don't worry, we'll keep it, clear and engaging.
Yeah, because understanding a company's financials is like, peeking behind the curtain. It reveals a lot about their health, stability, and ultimately their potential for success.
Okay, so where do we even begin? What are like the key things we should be looking for when we're trying to like decode these financial statements? Is it as simple as just like looking at their profits?
Well, while profitability is important, it's not the whole story. Remember, stockbroking is a cyclical business. Their earnings can fluctuate wildly depending on market conditions.
Right.
So we need to look beyond just the bottom line and consider, a range of factors.
Okay, so what are some of the key metrics that we should be paying attention to?
One of the most crucial is capital adequacy. Remember all those risks we talked about earlier? Well, brokers need to have enough capital to absorb potential losses, meet regulatory requirements, and basically ensure they can, withstand market shocks. It's like having a financial cushion to navigate those unpredictable bumps in the road.
Okay, so it's not just about making money. It's about having like enough reserves to weather the storms.
Exactly. And regulators keep a close eye on on capital adequacy to ensure the stability of the entire, financial system. And they use specific ratios and metrics to assess a broker's financial strength. And one of the most important is the net capital to risk assets ratio, or NCRAR for short.
Okay, that sounds a little technical. Can you break that down for us in a way that, even someone who doesn't speak finance can understand?
Sure, absolutely. Imagine a seesaw.
Okay.
On one side, you have the broker's capital, the money they have to cushion against potential losses.
Okay.
On the other side, you have their risk assets, the investments and activities that could potentially lead to those losses. The NCRER basically measures the balance between these two.
Okay, so the higher the ratio, the more capital a broker has relative to their risk exposure, meaning they're in a better position to kind of handle potential setbacks.
Precisely. A high NCRR indicates a strong capital base
Yeah.
and greater resilience to, market fluctuations. Regulators set minimum NCRR requirements for brokers to ensure they have adequate buffers to protect themselves and their clients.
That makes a lot of sense. Capital adequacy is definitely something I'll be paying closer attention to from now on. But what about profitability? Surely that still
Of
matters.
course, every business needs to be, profitable to survive. But with stockbrokers, it's not just about looking at their absolute profits. We need to consider their return on equity, or ROE, and return on assets, or ROA.
Okay, I'm familiar with those terms. ROE measures how effectively a company is using its shareholders' investments to generate profits,
Mhm.
while ROA tells us how efficiently they're using their assets to generate earnings.
Exactly. Higher ROE and ROA generally indicate, better financial performance and management efficiency. But it's crucial to compare, a broker's profitability to that of their peers and consider the overall market conditions.
Because during a bull market, everyone's profits tend to be higher,
Right.
while during a bear market, everyone's kind of struggling.
Exactly. We need to look beyond, just the absolute numbers and consider their relative performance and how they're, navigating the prevailing market trends.
So we've got capital adequacy and profitability. What else should we be keeping an eye on when analyzing these financial statements?
Liquidity is another crucial aspect. Brokers need to have, enough liquid assets on hand to meet their short-term obligations, such as, margin calls and client withdrawals, like having enough cash in your wallet to cover those unexpected expenses.
Okay, I've heard the term margin call thrown around before, but I'm not entirely sure like what it means.
Imagine you buy stocks on margin, meaning you borrow money from the broker to finance your purchase.
All right.
If the value of those stocks, drops significantly, the broker can issue a margin call requiring you to deposit more money to cover the potential loss. And if you can't meet that margin call.
That's when the broker's like left holding the bag,
Yeah.
right? Facing
Correct.
potential losses themselves.
Exactly. Brokers need to have sufficient liquidity to cover these potential margin calls and other short-term obligations. There are specific ratios that measure a broker's liquidity, such as the current ratio and the quick ratio.
Okay, break those down for us. What exactly do those ratios tell us?
The current ratio compares a broker's current assets, which are assets that can be easily converted into cash,
Okay.
to their current liabilities, which are, debts that are due within a year.
So it basically tells us if they have enough like readily available assets to cover their short-term debts.
Precisely. A higher current ratio generally indicates, greater liquidity and a lower risk of short-term financial distress. And then there's the quick ratio, which is similar to the current ratio, but it excludes inventory from current assets.
Because inventory can sometimes be like tricky to sell quickly, especially in like a volatile market.
Exactly. The quick ratio provides a more conservative measure of a broker's ability to meet their, immediate financial obligations.
Okay, so we've got capital adequacy, profitability, and liquidity. These seem like the big three when it comes to analyzing a broker's like financial health.
Yeah, they're definitely crucial factors to consider. But I imagine there's, more to the story. What about, the types of assets they hold and the level of debt they carry?
Okay.
You're absolutely right. Those are important aspects to consider as well. When we talk about, asset quality, we're looking at the types of assets a broker holds on their balance sheet. Things like, cash, securities, receivables. even property and equipment.
Okay, and I'm guessing not all assets are like created equal.
Exactly. Some assets like, cash and government securities are considered low risk because they're unlikely to lose value. Others like, corporate bonds or real estate can be, more volatile and carry a higher risk.
Right. So it's about understanding like the composition of their assets and kind of assessing the overall like risk profile.
Precisely. And we also need to consider their debt levels. Brokers often use, debt to finance their operations, which can be a smart strategy for growth.
Yeah.
But if their debt levels get too high, it can put a strain on their profitability and make them more, vulnerable to economic downturns.
Yeah, it's like walking a tightrope. They need to find that balance between using debt strategically to kind of leverage their growth, but also managing it, prudently to avoid excessive risk.
That's a great analogy. And there's a specific ratio that helps us assess this balance, the debt to equity ratio. It compares a broker's total debt to their shareholder equity, basically the amount of money shareholders have invested in the company.
So a high debt to equity ratio could be like a red flag, signaling that the broker is relying too heavily on borrowed money.
Exactly. It's an important metric to watch out for, especially when trying to gauge, a broker's long-term financial stability. So we've covered a lot of ground here, from capital adequacy to profitability, liquidity, asset quality, and leverage. It's a lot to, digest, but hopefully you're starting to see how understanding these factors can help you make, more informed decisions.
Absolutely. I feel like I'm finally starting to see the bigger picture here. Yeah. But I have to admit, it's also a bit overwhelming. It seems like there's so much to consider when evaluating a stockbroking company.
It can definitely feel that way. But, remember, we're not expecting you to become a financial analyst overnight. The goal of this deep dive is to, equip you with the knowledge to start asking the right questions.
Right.
And to approach your investment decisions with more awareness and understanding.
Okay. And as Dr. Malik reminded us, those glossy annual reports, they don't always tell the whole story.
No.
We need to dig deeper,
Yeah.
analyze the financials, and consider the broader context before making any investment decisions.
Well said. It's about, being an informed and discerning investor. Don't just rely on headlines or flashy marketing materials. Do your research, understand the risks, and choose brokers that align with your investment goals and risk tolerance.
That's great advice. So the next time I hear news about the stock market, I'll be thinking about all the behind the scenes action happening at the brokerage firms.
Yeah. They may not always be in the spotlight, but they play a critical role in our financial system. And remember, knowledge is power. The more you understand about how these companies operate, the better equipped you'll be to navigate the world of investing.
Well said. Thanks for joining us on this deep dive into the world of stockbroking companies. We hope you found it, insightful and empowering.
Until next time, keep exploring, keep learning, and happy investing.